Oh, there's not that many questions. Okay. Okay, guys. Woo! We're back. It's been a day. Like literally one of those days where I worked from like 9 a.m. to literally just like 2 seconds ago, hung up the phone and then jumped on this live. So yeah, let's see if I can get my brain all working right so that I can give you the best Lizzie to answer all of your questions about home buying and refinancing. I do want to shout out a couple people that are already on here, Junior and Rod. So awesome to have you guys on the live. Terry, wonderful to have you on the live. I'll be answering your questions here in a moment. I do want to touch on what happened in the market today because it was not a great day. I feel like Wednesdays just feel like it's not a good day for interest rates. That is just like anecdotal, nothing to set your locking data on, but it just feels like the last couple of Wednesdays I get on here, I'm saying, oh my God, interest rates rose. So, couple things that I have been talking about a lot on these lives is that anytime we hear that inflation is out of control, right, or inflation is higher than expected, we can expect that interest rates will go up. And that is because we know that the Fed has to pull back on their stimulus with the economy. And a lot of that comes down to mortgage backed securities, bonds. And so inflation numbers across the board were like almost a percent higher than anticipation. And they're like the core inflation number was over 6%, which is a really, really big deal, which just translates to like regular goods and services are increasing at a pace that isn't sustaining with people's actual income. So things are becoming less and less affordable. I know we are all feeling it. It comes to gas and toilet paper and then mortgages, right? So, we're definitely feeling it. So definitely interest rates bumped today. The other thing is unemployment dropped. Again, positive economic news, not great for interest rates. So that's what happened today in the marketplace. Aside from that, guys, I finally kind of figured out how to wear my hair curly. For those of you who've been watching that journey online, I'm pretty proud of my new do. Uh, I don't know why I mentioned that, but I did. Okay, so let's start. I have some emailed questions in, and I'm going to start off with Junior. So happy that you're here. Thank you for the respect on my mortgage knowledge. You are awesome. Rod and Laura, always great to have you on these live chats. So Junior says, I live in OC, California because of my situation, being divorced. I have to purchase near my kids' school since I have them every other week. Most 3 one-bedroom homes are running in the mid 700s and are not fancy at all. I found a condo for 300, 4 bedroom, 2.5 bath. Only downfall is there is a lease land. What are the pros and cons of purchasing something like this? Well, the pro is obviously that you're found something for 300,000, and that's because you don't own the land. Um, the cons are that in addition to, because it's a condo, in addition to having an HOA, you will also have a land lease payment. And sometimes, depending on the stipulations of the land lease, they can be hard to finance. And if they're hard to finance, you limit your pool to potential sell like buyers in the future. So harder to finance, additional cost of the land lease. But pros is that you're buying a property at well under the cost because you don't own the land. So yeah, in some cases, I think this is great. There's a lot of really like nice luxury properties here in Phoenix that are under those same stipulations. And a lot of people love to buy them. So, all right. So Terry Domrud says, do I handle the financing of HUD homes insured escrows 203K? There aren't many HUD homes now, but will probably change. Yes, I can finance in all of, anything that is backed by the government. So a HUD home is as a bank foreclosure that was financed through FHA. So we definitely do those. And 203Ks, I haven't done one personally in many years, but there is a department and loan officers that specialize in that type of financing at my company that I'd be happy to recommend you to if that is something that you're interested in. Okay, so we got Abe here, Steven here, Juan Carlos, Alejandra. Oh, you guys, Javier is on here. Danielle is on here. Oh, honey, I love you, love you, love you. Javier, I did return your phone call last night, by the way, and was in an all-day meeting today. Okay, so let's see. Did anyone hear about the country who started using balloons as currency, they ended up with a massive inflation problem. I love that. That's hilarious. Thank you so much. How much do I estimate mortgage rates will go up by summer of next year? Guys, it is so hard to predict that far in the future. There are lots of economists that are saying that by the end of next year, we'll see rates in the low fours. That's the best I can do is just kind of quote what economists are saying. Generally speaking, though, it does take some time. And again, I am putting together all of that research for the video that I'm going to be recording on what we saw the last time, as you know, when they started pulling back their stimulus, how we saw the knee jerk reactions in the market and how we saw it like incrementally increase in rates. All right. So, Mila, I hope that's how you pronounce your name, said, what steps would I recommend for first-time homebuyers? I love this question. So I always recommend that people, one, start off with just a general budget. If you're looking for a great budget, there's a downloadable worksheet on my website, lizziehoeffer.com. And basically what I'd like for everyone to do is just kind of itemize all of their actual like lifestyle expenses, their actual living expenses like housing, utilities, groceries, etc. And then see if you can live under 70% of your net take home income. Once you're able to establish, like, you know, that you are able to live in a budget, right? One that allows for savings and debt reductions, then you know that you're ready to take that next step in getting qualified for a home purchase. I would recommend speaking to a loan officer as early on in the process as like 12 months, one, so you can get an idea of your credit, you can get an idea of payments, of closing costs, and you can really set your financial goals that way. I've heard a variety of different opinions on why that's too early. You know, lots of people are like, oh, why would you, you know, of course I'm a loan officer. That's why I would say that. But in generally speaking, I deal with lots of first-time home buyers, and it typically takes someone 3 years when they just started and have no idea what it costs to buy a home to save up the amount of money necessary. So those would be my first steps to take. Lots of videos on this. Would love for you to check them out. We got Rihanna on here. Second, what Ollie said, love the jacket. Ooh, what did Ollie say? Oh, loving the hair. Great information. Oh, I love you, girlfriend. All right. So how can I get a job in real estate when I have no experience? What would you say is the best way? So the best way, truthfully, to get into real estate or lending is to just apply to work for a team, get licensed on your own, show them that you're proactive in this way. That's like really honestly one of the first things that I look for in people is, you know, did they get licensed on their own? And then you'll just work on their team, and if they're a great team, they will train you. It typically, like in loans, takes about 200 loans to really be proficient. But then like in a real estate, I mean, I imagine like the first 20 transactions will teach you a lot. Javier, I'd love your input on that if you're still on this. Oh, Jay's the best. Appreciate you, hun. He is married to my awesome assistant, Jen, who literally is the most incredible woman on earth. Keeps me positive, keeps me organized. You know, she's awesome. Okay. So AW says, looking at inflation numbers and they're off the chain, do you think we'll end the year under 4% interest rates trying to leave my mom's basement? Yeah, so inflation numbers are really, really scary. But here's the thing that the Fed constantly mentions is this temporary or not? So a lot of the supply chain issues are creating a constrained, you know, supply of goods. And whenever you have a limited supply or whenever you have like a bottleneck in supply chain, you typically see an increase of cost of goods. And so what they have said is that this is just a temporary bump in prices, or and as soon as, you know, the supply, you know, gets out there, that prices should drop. You know, they've also commented that, you know, some of the price increases are here to stay. So it's really hard to tell. I unfortunately am not proficient enough in economics to know how dangerous this truthfully is, because we've never seen ourselves in a scenario where literally the global economy stopped, right? And so many businesses have been just, you know, so many businesses, so many people have been put out of work. So it's hard to say because we've just never seen this historically. People have lots of opinions based on what's happened in the past, but no one really knows for this type of economy. All right. So, you guys, I love my team. Thank you for all the hair comments. Do I have any updates on the 15,000 first-time homebuyer tax credit? Still no updates. However, that infrastructure bill just got passed, and that was something that was talked about at the very beginning of the year. So it is nice to see that some of that earlier on legislation is now getting talked about and voted upon. So hopefully 2022, but I will keep you updated as I get information. How often do I do these lives Q&A sessions so I can get specific questions ready for next time? I peeked in because I got a notification from your channel today. Oh, well, thank you, Juan Carlos. I do them every Wednesday, typically at 6 p.m. But you never know. Maybe I'll change up the time to 4 p.m. Uh, I have lots of plans to do that. And it's just like, and just like my day job gets in the way. So there is that. Okay, so before I forget, because I'm not great at remembering these questions where people are like very specifically asked me to answer this question on live. This question comes from Michael Gyrus, and he literally emailed me yesterday and asked me if I would answer this on the live. So if you are on here, I'm answering your question right now. It says, can you answer this? Is it better to put more money towards my mortgage or save it in cash reserves if I plan on moving to a town with better schools in 10 plus years, which is likely going to be more expensive? So here's the deal when it comes to money, guys. If you leave your money in a bank account, it's going to depreciate with inflation, right? Now, you definitely need some liquid cash reserves. I talk about having anywhere between 6 and 12 months in your account of survival expenses. And that's because, well, shit happens and we don't live our lives for accidents and emergencies. So it's important to have some sort of liquid cash in the bank. But then aside from that, I think max out your retirement, invest in the stock market, and then pay down your principal mortgage. You never just want to leave money sitting in the bank not working for you. And I'm very, very passionate about this. I've recorded tons of videos on this, and I'd happily do a live chat just on money practices. No one ever seems to want to take me up on that though. So like pay attention to those things, but definitely don't just like leave it in the bank. And if you are going to be paying down your principal mortgage, the house appreciates at the same rate whether you do that or not. And if this is not your forever home, just know like it's better than, you're like what's positive about it is that you end up paying less interest. So when you go to sell your house, you have a bigger return at the end of it. But overall, it does like in the tiers, like pay things that actually have a return that's greater than the interest that you're paying. All right. So, Afar A, I'm glad you like the live. So I'm trying to understand what the heck is going on with the housing market. There's so much information on the housing crash and supply issue. Do I truly think it's a good time to move? You know, so here's the thing. It's a very personalized question. And I always tell people that you buy when your budget says it's ready and not anytime before. If buying a house is going to make you not be able to save money, not be able to pay your bills or pay down your bills, then it's not the right time for you to buy. There's always a reason to not buy. Like, seriously, I have been literally my entire career is like the market's going to crash, the market's in a bubble, the market's going to continue to bottom out. I have heard this literally since 2008 every single week. And so for me, it's like if I waited to purchase or I waited to make those investments, I would be out so much money. Think about the people that took the plunge in 2018 when people were saying, oh no, the market is turning. They would be out the 30% return that they just saw in the last 2 years. And so you have to realize that real estate itself is a long term investment with ups and downs, just like any other investment. And because you have to live somewhere, it's important that you live in a place where one, you can fix your monthly payment expense that will grow in equity for you, that you can at least take a tax deduction on. I mean, there's so many reasons why I advocate for home ownership, but if your budget is not in the right place, don't do it. It will only add stress to your life. So I hope that really helps. Yay, Shadow Llama. Might just be you and me on that money chat. Okay, so AW said, Lizzie, I heard you talk about doing a double first payment can drastically cut down the total amount paid. Can I elaborate on this and why is it specific to the first payment? So the reason that it's specific to the first payment is because that's what like all of the interest is based on. So you pay interest on the total balance of your loan. And so when you pay a double payment on your first one, so do a first like large principal reduction payment, all of the rest of your payments are calculated differently and more of that monthly payment, even though it doesn't change, will get applied towards your principal balance versus interest. And so that's why it's so important to do it. But anytime you make a principal reduction payment, it essentially has the same kind of reaction. It's just the greatest reduction if you do it at the very first payment. Okay, so Karen asks what the difference is between APR and interest rate. So I get asked that a lot. In fact, it's probably my most popular video on the YouTube channel. And so essentially, an APR is an interest rate that you can look at a glance to shop alone with. And essentially, what it is supposed to tell you is all of the fees and interest and mortgage insurance included in your loan amortized over the term, and it comes up with an annual percentage rate for what it cost you to purchase that house. And it does not include things like, property taxes, homeowners insurance, anything that's a one-time expense for properties or an ongoing recurring expense due to owning that property. These are one-time expenses due to the cost of purchasing this house and obtaining the home loan. So that's what it's supposed to do. If you were shopping scenarios and you weren't like really experienced with understanding fee sheets, you could look at an APR and say, okay, this loan is more expensive based on, the higher interest. Now, the rate that you pay interest at, right? So the interest that's calculated on your loan balance is the rate that impacts your actual monthly payment. And a lot of people get them very, very confused. And so people will think that their APR is what's impacting their monthly payment, but it's the interest rate. So the rate that you pay interest at on your loan balance. So I hope I did that justice. But yes, it's a highly asked question in mortgages. So Joyce at Time says, thank you. Do I have any information on how I can plan out my budget? Do you have a system that you could recommend to help me prepare for my purchase? Well, Joy Time, you must be a new Time viewer. I created what's called Smart Steps, and it's just your pathway to home ownership. So understanding your spending, what you're making, actually bringing home, what you have in assets. Do you need reductions in debt? Right. And then timing. How long will it take you to accomplish your goals? And so that budget guide is downloadable on my website, lizziehoeffer.com. And I have a bunch of different uh, videos about budgeting, a bunch of different steps and tools. But honestly, I would love to get your guys' feedback on things that you'd like to see. I actually spent the entire day working on Smart Sense app, which is going to really, really help homeowners figure out like their what if scenarios for purchasing, real estate, but honestly, just like lifestyle choices and spending. So I'm very, very excited. Would love your input. Okay, so what's the difference between loan amount versus financed amount? Ooh, so this you must be getting lots of truth and lending questions. So the way that they calculate APR is technically on your financed amount. And so for whatever reason, they take the finance charges for your loan, right? So title and mortgage costs, and then they minus them from your base loan amount. And that's what is your financed amount. I'm not 100% sure on why they do that. I just know that's what it is. And your loan amount is actually the difference between your purchase price and your down payment, except when you are financing in mortgage insurance, like on an FHA or a VA loan. You have a base loan amount at that point, and then a total loan amount that includes that mortgage insurance. That's probably way too mortgage nerdy for you guys, but that is the answer to that question. Okay. So Steven says, how can I prove that I don't pay my wife's car as I'm trying to qualify for a loan on my own? The problem is due to some bank issues. We only have 3 months of statements and they want 12 months. So this actually happens quite often. You just have to go to the bank and they should have a transaction history from her account of all the times that she's made those car payments within the last 12 months. If you can show 12 consecutive months of payments on an account that you are not attached to, this should be enough to omit that from your debt to income ratio. Now, if it is an FHA loan, though, and you live in a community property state, you may have to include it anyway. So there's that. Okay, so how does one get rid of PMI? Is it twofold where your home appreciates, it reaches 20% equity? Ooh, that's a really great question. So, it depends on the type of loan that you have. There's some types of loans that you pay for the life of the loan, like FHA, and then there's other types of loans that it depends on the type of mortgage insurance. So, like your conventional loan. So generally speaking, most conventional loans, if you have 25% equity, if you're waiting for the home to appreciate at 25% equity, you can call in and request that they do what's called a mortgage insurance termination. It would require an appraisal be done on your property to ensure that. And it would be done at the servicer's appraiser's choice. Now, if you're going to be paying down the mortgage, right, at 20%, you can call and do the same thing. It doesn't automatically fall off though, guys, until you've reached 22% equity for pay downs. So just an FYI, you guys always want to pay attention to that because they can get 2 additional years from you or 2% additional payments from you in order to like knock off your mortgage insurance. So just an FYI on that. Okay. So a couple of the questions that were emailed into me. Okay. So Terry, oh wait, no, that was already there. Okay. So what happened to our 5 p.m. start time? Did I say we were going to do 5 p.m. start time? Okay. Okay. So I'm considering a cash out refinance. What I mentioned okay. Sorry, guys. Sometimes when people send in questions, I like legit have like nervous reader syndrome online. I like just forget how to read and my tongue doesn't like coordinate with my brain. So, all right. So it says, I'm considering a cash out refinance and a loan payment for 30 years for something that will be paid off in 10 years. Should I continue? A bit confused as to what to do. What's the best way to do the math? Technically, it seems I'll pay $250 a month extra for 30 years. Okay. Okay, so this guy's question is just awkwardly worded. So I'm just going to go ahead and try to interpret what he's saying. So a lot of times when people do refinances, the typical quote is for 30 years. This gentleman wants to pay his house off in 10 years, but sometimes you can only qualify for a 30-year fixed mortgage depending on, the type of income. I know a lot of self-employed borrowers write off a lot of income. And so sometimes it's challenging for them to qualify for shorter term mortgages. So in that case, what you're going to want to do is go ahead and request an amortization schedule and then ask them to do what if scenarios on principal reduction payments. There's a really, really good amortization calculator. And you know what? Darn it, I don't know what the website address is, but if you come on the live next week, I will have this that will help you like work out all the hypothetical situations on, principal reductions and how fast you can pay off your mortgage payment. So just know that that's what it is. But essentially, that's what you would do to figure out how to pay it off in 10 years if you could only qualify for a 30-year fixed refinance. Okay, and then Ephraim says, I have a house paid off. What do you recommend? Me to refinance or get an equity line of credit? I've got a few bills to take care of. So here's the deal. So a line of credit, I like when it's a small amount of debt that you're going to concentrate on paying down right away. So the interest rate is higher than what you would get on a regular cash out refinance, but it's simple interest. And honestly, you can pay it down quickly. And so if it's like $20,000 or less, generally a line of credit is typically what you would need. Now, let's say you're going to be paying off, a significant amount, and I've seen some people, borrow like $100,000. It would always make more sense for you guys to just do a regular cash out refinance, just because you would never want a variable rate on a loan amount that high. And because we know interest rates are on the rise, anytime you have to borrow a significant amount of money, you want to make sure that it's fixed in this type of environment. Okay, so all right, so let's go to here. So AW says, it looks like my new construction house has completed house selling. Oh, wait. Oh, has new houses completed selling at a higher than I locked in at? How long do I have to wait to request the lender to remove the PMI? So it's 2 years, guys, of paying mortgage insurance and then 25% equity before you can request that they remove the mortgage insurance on a conventional loan. When purchasing a new home, who pays the realtor fees? Curious if I need an agent for a brand new house. So here's the deal, Solomon. Okay, so typically it's the sellers, or we've been grown accustomed to the sellers paying both agent fees. In this market, I've seen both buyers and sellers pay it. But on a new construction, the contracts, especially due to all those labor issues, supply chain issues, building issues, are not written in your favor, and not having representation in this marketplace is very dangerous. So I think they're worth paying the realtor fees on, especially because they're your intermediary, and you want to make sure that things are going right. And sometimes it's hard for a client to advocate for themselves, and having that third party person really helps. So I definitely would work with a realtor. And especially most new builds are also paying for realtors. All right. So if I wanted to switch to a 15-year loan, should I pay my mortgage like it's a 15-year rather than refi it? So this is where you have to do a side-by-side comparison and really look at it and decide if it makes sense. There's a cost to doing a refinance, but sometimes you can save over 1% in interest, and you can do things like that are shorter than 15 years. So or you can, like what most people don't know is that you can customize your mortgage terms. So like I had somebody yesterday who called me for a 25-year mortgage. So it's interesting to see like what all you guys could do with that. But assuming that you just like it doesn't make sense, your interest rate was already super low, like let's say you got a 2.75 interest rate on a 30-year fixed mortgage, then again I would just get an amortization schedule and figure out what it would take for you to apply an additional principal every month to pay it down in 15 years. Can a loan lender provide me loan options based on my monthly mortgage budget to include principal insurance and mortgage insurance? And can I tell the lender that I don't want to pay more than $2,000, for example? Yes. Absolutely. So a lot of times clients come to me and I ask if they already have a budget in mind. And so they'll tell me what their budget is. I go through that. And then I also give them like what their maximum qualification amount would be, just so that they have an idea of what their range is and flexibility. So I think it's always important to know both, because oftentimes you will find that you have a set budget, but really, you can pay slightly more, or really you feel less comfortable paying, or that's like your absolute limit. And you really want to have a decent range. And, you would be surprised. I see clients from all ends of the spectrum, from like wanting to qualify at their max. They're like, oh, I can afford 2000. And then we get them more in line with a lower payment, or it's the opposite where they came in, they want to pay 1400 and they can easily pay like 2200. And just knowing what their shopping power is will help so much in the just home shopping process. I hope that made sense. Okay. What's the difference between using a mobile notary service and going into the office to sign? Are there any cost savings? Yes, you will not have to pay. Well, actually, hold up. So, yes, it used to be that if you went into the office and scheduled signing with your actual title agent, you didn't pay a separate notary fee. And that was really great. That savings somewhere between like $100 to $300, depending on the area. But now with COVID and the volume of transactions, I am seeing quite a few notary fees that are included in the office signings as well. So you have to check with your title office or the escrow office. But one thing that I will tell you is that going into the actual title office saves a lot of time in questions. And so if you have like an inexperienced notary, they can be really unhelpful. In fact, cause more issues during your signing by giving you misinformation or scaring you. So oftentimes going into the office will make that closing experience a lot nicer for you. And if you are signing and funding on the same day, just not having them have to wait for a courier or a notary to bring the docs back will save you time and ensure a faster closing. All right. So, what's my opinion on what happened with Zillow? Ooh, what a hot topic. So, a couple things. So, anytime you hear that a company is laying off 25% of its labor force, it's a sad news day. Like, I get that I work in real estate and that Zillow has been just a very controversial company when it comes to realtors and lenders. And so for me, like, just first and foremost, I think it's really sad that they were laying off that many people. They had interesting reasons for what happened, why they stopped buying. And one opinion is, that maybe they saw something in the market that they are concerned about, and the other opinion is that they were overpaying for properties and they were, losing. I mean, they've not been profitable for forever, so honestly, I wasn't that surprised, but they saw supply chain issues, more labor issues, and they just, he was worried that the entire company would go belly up if they kept doing it. So my opinion is, I don't think that it's going to actually impact the regular consumer. They own about 7,000 properties. A large majority is in Phoenix, but they're looking for another institutional buyer. So, like an Invitation Homes or an Open Door. And I don't know how many of those homes are actually going to be resold to the regular consumer. So, I don't see a flood of homes entering the market. And I don't know that it says that, that the market is tanking either. It is really interesting news, though, and very sad that all those people are losing jobs. Okay, so let's get some more questions in here, guys. Okay, so I was told that you could only do a cash out refinance based on the purchase price, not the current value. Is that true? So I purchased a house cash for 330,000 and it's worth 370. Ooh, that is such a loaded question. So within a certain time period, you're typically limited to just the purchase price. So typically within 6 months of after buying a property, you're limited to the purchase price. After 6 months, you can do the appraised value unless you have paid cash from your personal accounts, right? So not gifted money from another family member, or not a private loan from somewhere else. So this would have to be like liquid cash that you use from your personal bank account to buy the house. You can actually use the appraised value day one. So it depends on how you ask the question and what your specific scenario is. But if you paid cash with your personal accounts, you should be able to buy now using your appraised value. Okay, so at what point can an escrow be terminated? For example, if a homeowner had a preference for paying the property taxes on their own versus having an escrow payout. Oh, oh my goodness. So, guys, at first, when I read that question, I was like, wait, what? So, an escrow is also what we call a purchase transaction. So, like, I was like, at first, I thought she was talking about an actual contract. What she's talking about are the impounds for taxes and insurance. So, most companies, if you are putting 20% down, will allow you to cancel out your escrow payments or, opt out of impounding after 6 months of payments received. Okay, so can I explain what happens when I offer 500,000 to buy a house that is appraised for 465,000? I have to come in with the remaining balance along with the down payment? So it depends on how your contract is written. So obviously you offer a purchase price prior to getting an appraisal, but the way that your contract is written will determine whether or not you owe that difference. So if you guaranteed a purchase price of 500,000 and said that you are waiving your right to lowering the price due to appraisal, then yes, you would be obligated in that. But if you did not and you have an appraisal contingency, you could back out of the contract or you could renegotiate it. Hypothetically, you could always renegotiate it, but you might not always get your earnest money back if the seller decided not to proceed with that, if you did waive a contingency like an appraisal. So it depends on how your contract is written. Sorry, I couldn't be more specific with you. So AW says, hi, Lizzie. Over the next decade, do you think U.S. homeownership rates will rise, decline, or stay the same? I don't see lots of people my age, 30, owning their own house like in prior generations. So millennials have actually waited quite a long period of time to buy their first homes. So just in general, our generation is just taking longer to buy homes. Um, I mean, I think that everyone has to live somewhere, and millennials are a gigantic generation, and Gen Z is an even bigger generation. And so, just because of population growth and housing, I do see the rate of homeownership increasing. Now, having said that, mortgage applications actually, the informations were just released by the MBA, which is the Mortgage Brokers Association. And they are showing that we have a decline in purchase transactions right around like 4% year over year. We are down 13% in inventory, and we have a large, like double digit percentage of cash buyers in the marketplace that account for that. So it's hard to say if we're actually seeing a decline in, well, we're seeing a decline in purchase applications. Whether or not that says that we're seeing a decline in home ownership, I don't have that information yet, but I don't believe so. I think that just straight math says that it has to go up. Theo B says, can you use proposed rental income when buying a rental property to qualify for a mortgage? So kind of. So you can use the proposed rents to offset whatever the future mortgage will be on the rental property, but you can't use additional income from it. So we use everything at 75%. So assuming rent's like $1,000 and you're getting $1,500 from it at 1,500, and 75% of 1,500 is what we're actually able to use as the rent. Any overage can't be used as income, but it can offset the full monthly payment. So I hope that helps. Is it true closing costs for new construction homes are a lot higher? So it depends, truthfully. I mean, guys, it's so funny how many people just say like blanket statements like all new builds. It depends on the lender, first and foremost. It depends on the situation for the client. Generally speaking, and this is not true for every single situation, which is why you always need to get a mortgage quote from a variety of places. I do see that the builders, lenders charge premiums for their purchase prices or for their lending, well, and their purchase prices, but they're typically offset by lender credits and offset by seller credits. So it's really hard to say whether or not they'd be that much more expensive. Millennial Money says, when purchasing a new build, when in the process do you need the entire down payment? I understand the EMD check will be needed up front. So it depends on your build time. Typically, they'll want to have your loan underwritten within 21 days of your initial contract. And so some lenders will not submit your loan into underwriting without knowing where the down payment funds are at least coming from. If you're planning on saving the down payment funds, I would at least have that saving plans done 30 days prior to your anticipated closing date. So that's what I would do, because it takes sometimes up to 30 days to get your loan underwritten. And so that's like the longest you should wait, period. Okay, so AW says my builder in AZ gave me 6,000 back for closing and other things. Yep, and that's very common. Do I think the market will ever change if builders catch up with demand? Will prices go down or stabilize? I mean, guys, yeah, eventually the market will curve. I mean, nothing is like we cannot sustain this type of appreciation. But I don't know that things will crash, right? So we're already seeing appreciation decline, and that is not housing prices, guys. That is the future value of homes. That is what's going down, and it's not saying that home values are not going up. It's saying that they're going up at a much slower pace. So to explain that easier, because I don't think I just did a good job, the last year we saw like 29% increase in home values. That is ridiculous. That is not normal. A normal purchase, like housing market, that's a good housing market, is anywhere between 5 and 7%, right? That's healthy. Stable is considered 3% increases. And so when you think about like how rapidly home values have been increasing and now how much slower they've been, now they're like right back at like 0.3% monthly, right? Which is in some areas going to add up to be like, 6 to 8%. I mean, that's a fairly good return on your purchase, but it isn't like what people are expecting. And the headlines do read like home values are going down. Very confusing. Okay, so Millennial Money has 7-ish%, but hoping to have 10% by then. How long is your build time? Just curious. Goonies has a question about modular homes. So this is like one of those random trivia questions I hope to be asked one day on a game show. But modular homes are very similar to manufactured homes. But the big key difference is that they are constructed on site. So they come in parts like, this is like basic explanation, but let's say it came in 4 parts, and your house was a square. Each part would be set up on the lot and affixed to the property. A manufactured home comes already completed together and then is put on the property. Benefits with a modular home is that they are priced out in terms of um, interest rate the same way that a stick built home would be. So, like a regularly constructed home, like with brick or stucco. So they're priced out the same. But in pricing, right? So because the materials don't last as long as a regular stick built home, generally the prices are lower and they're priced out more similarly to a manufactured home. So that's what the differences are. I love modular homes. We have lots of them in Arizona. So, yay, modular homes. All right, let's get some more questions in here and I'm going to answer some of the rest of these. So, my name is on my sister's deed. She recently passed away. Can I sell the house? You guys, I get asked this question so much. Just because your name is on a deed does not mean that the property passes to you and you have 100% ownership of that property. This is why it is so important to understand how you're taking title. So, when you take title with another person, if it does not have like the verbiage rights of survivorship, technically that person who passed away, all of their heirs have a right to their equity and the property has to go into probate and it can be super messy. So, you really will have to make sure that one, the property is awarded to you. And then when you have full rights to the equity, you can then sell it or you can refinance it. But it is really tricky and it's important why you need to talk to an estate planning attorney, talk to your title officers whenever you are purchasing real estate, just in general, flat out 100% of the time. Cool. Let's see here. So I own a home with my sister. We both reside in it. You say pay attention to the right of survivorship, but pay attention to what? How do I find this? Is it in my loan documents? Okay, so it's another really great question because I just elaborated on that. But you guys dictate how you take your title, so how you take ownership at the very beginning of your purchase contract. Many of you guys ignore the title company, but they send you lots of emails. I think they should make more diligent effort in terms of phone calls, truthfully. But they do send you lots of emails. You do get a package in the mail asking you for information on how you would like to take ownership. Um, if you guys need a PDF, I think I downloaded one when I talked about this in a video, but I'll have it. It'll be in the resource page of my website. I'm going to make sure to upload that. Jen, if you're still on this, make sure to remind me of that tomorrow. But it's super important for you guys to learn what that is and not to find out after the fact. Like they've already closed and lived in a home and have no idea how they take ownership. Like that's not a great way to buy a property. Okay. So, all right, let's see here. So the loans are the same. Yes. So modular homes are the same as a stick built property, but not the same as a manufactured home. Manufactured homes require so much more an engineering cert, septics, cert. I mean, and the pricing is worse. All right. Girl, tell me where you got that jacket. It's so money. Oh, thanks, honey. I love money jackets. I'm pretty positive that this is an Alice and Olivia jacket. That's like basically where I buy my blazers, all of them. Okay. Can you change how to take home ownership of a property after purchasing it, or is it set up once in stone? So yes. So generally, what I tell people um, is to either get with a title company or a deed preparer to, change the deed. But more preferred is talk to an estate planning attorney who can put the property in a trust or dictate the ownership rights with a will. So I think it's very important. Now, if you're buying with friends or you're buying with a partner that is not your marital partner, I would get a cohabitation or joint ownership agreement and then just really like formulate what you would want to happen should something bad happen to you. All right. Let's see here. How do I figure out where the next big zip code is? Well, actually, so there's a lot of different strategies for this, but planning and zoning will tell you where all the home builders are going, where all the permits are going. If you're looking for infill, which means like in the city, you'll want to look at like the big builders, like the custom home builders, not like the like KB Homes or the Mary Kay. You want to look for like the smaller to mid-sized developers. You'll want to see where they're pulling their permits, right? And so that generally will give you a good idea. And then you can also call the municipalities to find out where, big stores like Target are going. Um, you know, Areas that have like nicer shopping or newer shopping that are going in typically mean that they are going to be up and coming. Well, I hope that helps everyone. Okay, guys, we got like 10 more minutes left. And I love that I've had like such good, consistent viewership. Oh, guys, it would mean so much to me if you would like this live right now. So that way it can go out there and, get all that YouTube love. All right. So let's go here. So Chauncey says, thanks for this video. Very timely topic. I'd love to hear my opinions on mortgage loan insurance that pays the lien off in the event of an owner's passing. I've heard very mixed thoughts on this in the industry and find that a lot of consumers have never heard of it. So when you close on your home loan, you are going to receive an ungodly amount of mail, like so much mail about refinancing, literally like the week after you close. It's like refinancing galore, people wanting to charge you for getting copies of your deeds, which are available as a recorded document that you can print off yourself. And you also get a copy from your title company. And then you're going to start getting inundated with these offers for mortgage life insurance. And you guys, it's crazy because of how specific they are. But you can get life insurance and then dictate where the money goes to. Oftentimes, I see people like they're so concerned about being able to pay for the house and they forget that they've just lost a ton of income, like household income. And so they pay off the mortgage, but it doesn't solve the income issue. And so, what I always recommend when it comes to insurance of any kind is that you speak with somebody that's like works as an expert in that area, so a financial planner, and talk to them about the amount of life insurance that you would need, one to pay taxes, one to cover your expenses, and then how much income you are replacing, right? So that's what I would do prior, like before I would just pay off a mortgage. These advertisements are done to scare you. You've just done like your biggest purchase ever. People are highly emotional when they do this, and they catch them at a time where they're susceptible to buying things like this. Now, if you purchased it, I'm not saying it's a throw out the policy or whatever, but I am saying that you probably would be better served with the life insurance policy. So that's my multiple cents on that. Okay. So first time home buyer with a down payment 10 to 12,000, is this necessary? Yeah, it is necessary. Most home loans require a down payment in this marketplace, anywhere between 3% to 5% down. You can get a down payment assistance program that will help you with that, but generally $10,000 to $12,000 is a reasonable amount of money that you would be paying to purchase a home. Okay, if my significant other lives with me for a prolonged time paying rent, do they have rights to my property? Um, if they are not married to you, then they do not have rights to your property. You have every right to rent out rooms in your house, and tenants don't have rights to your property, and that's how you would look at that. Now, and I don't, you know what? I'm not a lawyer, so there's that, but I'm pretty sure that Arizona does not recognize like common law marriage in community property, but you really would have to speak to an attorney about that, especially if it's like a prolonged amount of time that you guys split joint finances and things of that nature. So, but I'm pretty sure that Arizona does not recognize that. So there's that. All right, guys. I've got time for one more question. So let's get it in here. And I think I've answered all of them on interest rates. I don't really want to go back to that. But yeah. Okay. Well, guys, I love you. And I appreciate you guys always joining me on these lives, for being such advocates of the channel for me and my business. Um, I'm exhausted. I've had like such a long day. So, if there aren't a whole lot of questions, guys, I'm just really honestly going to say thank you so, so much. I love you. I'm sending out so much love. We'll be back next week with another live. And so I will see you then.